Good to see you all here again. I think this year we have a bigger turnout than last year, of course reflective of the markets as well. So it's actually a sentiment indicator. I think this year is average, not too high, but probably not too low as well. So today I'm going to talk to you a bit about our outlook for 2024, navigating the next wave of rates, policy, and tech trends. So I think this year is all about cycles and trends, and so I'll bring you through some of our key themes for the year. So we'll start off with a global review. I'll give you a bird's eye view of what's happening to the economy. Of course, given this short session, we won't be able to cover everything, but just the key points. Then we'll walk through a bit of the themes that we have for Malaysia before talking a little bit about fund selection. So let's start with a quick review of what happened last year. So last year, we saw developed markets, DM, really outperform emerging markets, EM. So countries and regions like the US and Europe really outperformed with more than 21% return, whereas Asia was actually dragged down a lot by China and Hong Kong, with Thailand also bearing the brunt of that. Locally, I think the KLCI, I think it's pretty flattish, large caps down about 2.7%, whereas the broader market did slightly okay, flat, and the small caps up about 9%. So let's talk about the three key regions in the world, US, Europe, and China. So starting with US. So how we look at fundamentals is that we look at two major things, right? So the first, we look at growth and inflation, because that's the major driver of earnings. And number two, which is government policy. And usually that drives your multiple or your PE, right? So looking at what happened to growth last year is that US growth was stronger than what anyone had expected. It turns out that US was much more resilient, and that's due to a couple of factors. And actually, if you ask me, I think it's due to the fact that the COVID crisis really created a lot of disruptions and new things in the economy that was not being able to forecast properly by economists looking at standardized models. Last year, we saw that the shift to services continued. So, when during the COVID pandemic, people bought a lot of goods, but I think in the last 2 years, people really switched to services in terms of travel, and we saw a new trend, which is the AI revolution that took hold of the US market. And so last year, I think the US is on track to record about 2.4% growth. For a large economy like the US, that's quite high. But of course, this year is expected to come back down again to 1.3%. Now, this is a forecast at the beginning of the year, although this could stand to change. So there is actually a potential of a slowdown this year. Of course, we are still monitoring the labor market, most importantly, to see whether this slowdown is something more of a soft landing or it's something more serious. So I think the jury is still out. It's still not too clear yet. But at least for now, it does seem like the economy is on a decent footing. Even the Fed also said that the outlook this year is uncertain, and so they're taking a more cautious stance on raising interest rates. So the market is actually forecasting that they will start cutting interest rates this year as the economy slows, and they're looking at the labor market. And the key thing, why everybody looks at the labor market in the US is that US companies are very sensitive to economic conditions. Once things slow, they will start laying off employees straight away. I mean, in countries like Asia and Malaysia, we tend to be a bit more, protectionist of the workers. So even when economic conditions slow, you don't really see companies doing big retrenchments. But in US, it happens quite easily when the economy slows. So in US, I think we have reached the end of the hiking cycle. If you look at the CPI inflation, it's actually down to about 3.1% in November, and actually close to the Fed's target of 2% plus. So actually, the Fed has stopped raising interest rates already, and the market and economists also all expect the Fed to cut. So I think the key question is how soon and how much they will cut. Some say they will cut as soon as April, May, but some say it may be later. So I think it's just the timing that's a bit under debate right now. And also the extent. Some people say it's going to be 3 to 4 cuts of maybe 75 basis points to 100 basis points this year. But at least, we are reaching the point where we are on the downward path in interest rates. And this is just the interest rate forecast. The yellow bars just show you the number of cuts into 2025. So I think the market right now is pricing about 7 cuts by January 2025. And we see the US CPI coming down to support that. Okay, so that's the US in a nutshell. What about Europe? I think Europe, not that much to say. I think it's a pretty slow growth environment for Europe. In 2023, they grew 0.5%. This year, the expectation is the same. So for Europe, I think it's a very mature economy. I think it will just coast along at a very subdued growth level. Europe is also quite similar to US in that they are coming out from an inflation problem. They previously had inflation go up to about 6-7% as well, and that's why they also followed the US in terms of hiking interest rates. But for this year, there is also expectation that interest rates will be cut, as CPI has also come down to between 2 to 3% as well. So this is the Europe CPI index. You see last year it rose to a high of almost 8.5%, but now it's come down to almost 2%. So we think that the US and Europe should be in a synchronized cycle of actually cutting interest rates this year. Okay, the big two done, US, Europe. What about China? So I think China, we see that actually the big drag and the big issue with the economy is the property market, of course. The key thing is that the home prices continue declining. We see month-on-month decline of 0.8% in November. And new home sales also decline about 10%, 8 to 10%, in value and volume terms. So we see this chart here showing you the month-on-month change in home prices. It's been coming down last year. The chart on the right shows you that actually new home sales is also in the negative level. The blue color line is actually the mortgage rate reversed. So the higher it is, basically the lower the mortgage rate. So the mortgage rate has been cut by the government, from almost 6% now to almost 4%, but that has not been effective in actually stimulating the sales yet. So we see that actually other sectors of the economy are still okay. So you look at fixed asset investment, it's up 3%. If you look at manufacturing infrastructure investment, it's up 7% and 5% respectively. But property investment is actually down 11%, and that's pulling down everything else as well. If you look at overall retail sales, it's actually up 10% in November year on year. And auto sales increased about 15%. So actually the key drag, if you see the chart on the left, is the property side, which is the dark blue line on the left-hand chart, is actually dragging down the economy. Whereas actually retail sales are still doing at a relatively okay pace. So the key issue that the government needs to be fixed is property. But the key issue with property is that it's of course a very big sector, and it's not so easy to turn around once confidence has been impacted. So last year we've seen that the government continue to implement stimulus measures. I mean, they've been cutting the mortgage rate, like I showed. They've been reducing the down payment requirement. I think different regions have different policy. But I think for some it's like from 30% down payment, now it's like 20%, and some even potentially going lower. And then recently they've started to announce, new infrastructure construction projects like the village renovation project to actually stimulate the construction demand. But for now, I think it's good direction, but it's not enough to turn the economy and market around yet. So we really need to see this year the government to step up their efforts to spend more to stimulate the property environment. Because actually property is a very big sector. Property impacts construction, it impacts home furnishing, it impacts furniture purchases, all the ancillary services. So it affects a lot of other sectors as well. That's why it's such a key sector to actually turn around. So in short, our summary for the regional outlook is that we are a bit neutral on the US. We think that it has really done well last year. Valuations are expensive, but of course, I think there is still growth to be found there. And the declining inflation, and if the Fed cut interest rates, that will be positive for the market. So I think you still see positive return for this year, a bit with some volatility when the slowdown does hit. For China property market, the key issue, we really need to see measures to address this sector before we turn more positive. But we are more selective on China. We think that selected consumption plays, stimulus beneficiaries, and certain exporters will still have some opportunity to do well. Korea and Taiwan, we think that it's on an improving trend because the semiconductor inventory cycle has already bottomed, and I'll explain more in the upcoming slides. And also selected developments in the AI space are actually benefiting companies in Korea and Taiwan. On ASEAN, I think we are overweight Thailand and Indonesia. Thailand has done poorly last year. We see that the tourist arrivals to Thailand from China has actually been way short of expectation. But we think that over time, this will normalize and they will start to come back. And the government has also announced an aggressive handout policy that should be approved mid of the year. And given the really poor performance, just a bit more positive in terms of news flow can turn the market around. Indonesia is going through a bit of election, so I think first half might be a bit muted. But after the elections is concluded, we still think Indonesia is a very good structural story in terms of consumption and FDI. Okay, let's talk about Malaysia now. I think for Malaysia, we will highlight the key investment themes in Malaysia. Number one, we think that GDP growth will still be stable and strong, and there are actually 4 themes to consider. The first theme is that we think that this year is a year of execution. So last year, the government has been quite preoccupied with the state elections and also arranging other things. But this year is actually when the year they put their plans into motion and execute on the big infrastructure and construction projects they have also promised. So that would be one theme to play. Number 2 is actually rising FDI. We see more inbound investment into Malaysia as a result of diversification from China, as mentioned by my previous speaker. Third, we think the tech cycle is rebounding. This will benefit the Malaysian tech sector as well. And number 4, the theme is that we're coming from a situation where Malaysian market hasn't been really paid attention to by foreign investors, and we're trading at quite cheap valuations. So number 1, let's talk about growth first. Last year, 2023, growth is forecasted to come in about 4%, I think pretty decent level. This year, it should accelerate to about 4.5%. I think more bullish forecast is closer to 4.7, 4.8%. And this will be driven by actually investments and a turnaround in exports. We think that consumption will still be a bit weak, given that the government has actually announced a lot of new taxes and subsidy rationalization. So you see that they launched the PADU database. I'm sure you read the news. So that is actually a precursor to actually reduce the fuel subsidies. I think that will happen in the second half. That might impact consumption a bit. And also we see that there's an increase in service tax, an increase in low-value items. The things you buy on Shopee, my friends tell me, is getting a bit more expensive already, and as well as a luxury tax. So consumption could still be impacted this year. So how to play this theme of improving GDP growth? I think the banks is one. We see, the banks last year, there's been slow loan growth, a bit of drag because of the non-household sector. Basically, corporates have been a bit more cautious, ahead of the state elections. But I think this year, with more political stability and more clarity on the contract award, I think the corporate loan should pick back up and allow banks to increase their lending. And that should also improve the NIM, which is actually the net interest margin that banks can enjoy. So last year, we saw actually a decline in the bank's interest margins because of slow loan growth and more deposit competition. So we like the bank sector. We think that loan growth will improve and the NIMs will also bottom. And now let's talk about the second theme, which is the policy execution in terms of infrastructure and construction. So the government has actually come up with a lot of plans last year, and this year we should see the plans being put into motion. So of course this is a big plan, but at least the government is putting a lot of focus on the manufacturing sector and bringing in FDI. One of the key policies is also the new energy policy. The government increased the target to actually 40% in terms of RE capacity, and eventually to 70% by 2050. Now, these are very big numbers, but whether we get there or not is not so important, but what's important is the direction. At least we are actually targeting a very big increase in RE, and actually that's more important than whether we actually hit 40 or 37 or the actual number. So we see that the government will actually promote the use of solar, increase the use of renewable energy, and also put into place a lot of the infrastructure required. And we're talking about electricity exchange with Singapore as well, where they will start to supply renewable energy to Singapore. So this is the roadmap. And also this year we should see more key infrastructure projects being rolled out. This is the proposed MRT3 alignment. And also in Penang, they've proposed the Bayan Lepas LRT, which should encompass most of the key areas in Penang. So the MRT tender has been extended to March, but the land acquisition should actually start soon. They have also revived the 5 LRT stations and also approved the Penang LRT project. In terms of Sabah Sarawak, there's also a link road, about 7.4 billion to start soon. So we see that this year they should really kick into gear a lot of these construction projects, and there should be multiplier effects on the rest of the economy in terms of higher wages, building materials, and other things as well. In terms of infrastructure, there's also a lot of new investments in data centers. I'm sure you're reading the news. So aside from the ones that we see in Johor, there's also been investments by other MNCs. So in terms of the forecast, we see that now we have about 100 megawatts, but we should see an additional 800 megawatts progressively coming on stream over the next few years, and also some in the greater KL area. In terms of property, these infra projects will also benefit developments. A lot talked about Johor right now, with the Johor rail transit system to be ready by the end of 2026. So we see property prices along the line already starting to move up, so close to about 1,000 per square feet already. And they're talking about increasing connectivity even after that, via maybe more rail links or maybe even a bus link. In terms of the high-speed rail also, it's been, I think the government is actually pushing hard for it as well. So this should be positive for actually those landowners that own land across the line, aside from the construction awards as well. So I think this year is already a year for execution in terms of infrastructure and construction. Key developments in Johor, the RTS, the special economic zone. We have a special financial zone for Forest City, MRT3, HSR, and also the relaxation of the MM2H guidelines. So at least the government is emphasizing all this, and it's moving in the right direction policy-wise. Okay, so the second one that I mentioned in the list of themes is the tech and FDI cycle. So in terms of FDI, I think last year we saw about 225 billion for 9 months, and actually this is actually on track to exceed 2022. In 2024, we expect more, and we see a lot of companies that are trying to diversify production out from China come into ASEAN as well, and Malaysia is a key beneficiary of that. So just to highlight some of the key ones, I think we see companies like Infineon, which is actually part of the auto supply chain, investing about 25 billion. This company called Innovix, it's actually a battery technology company, going to invest 5.8 billion. So a lot of big global MNCs are starting to diversify and actually have a bigger production base in Malaysia. So actually this is positive. Okay, that's FDI. In terms of the semiconductor cycle, so we think it's going to improve as well. I think the key drag in the last 2 years was actually the smartphone and PC market. So we saw actually 2 good years in terms of the pandemic, where people stuck at home actually bought PCs and smartphones. But following that, in 2022 and 2023, both the PC and smartphone market recorded negative year-on-year growth. That means the volume of smartphone and PC shipments have declined. So we think that these 2 years have already normalized the excess purchase during the pandemic, and 2024 should be a year of rebound for smartphone and PC sales. So this is the cycle. And we see that actually smartphone and PC and memory are seeing that the inventories are coming down, and we see that sales are starting to pick up. So we are at the bottom of the cycle and starting to pick back up. Of course, the debate is how strong will the comeback be. I think that is still yet to be seen, but at least we are on an improving trend. So actually, if you look at it, I think last year for Malaysia, we still recorded negative growth in terms of exports, and that was one of the key drags in terms of GDP. So last year, for 11 months, exports were down 7.8%. But this year, I think part of the driver of the stronger GDP growth is that exports can turn around and record a positive growth. So point number 4 in terms of themes is that we're coming from a low base. Foreign shareholding is very low. Last year, I think it was still a net sell position. And foreign shareholding on Bursa is actually now only about 19.6%, which is only slightly higher than the GFC lows. So I think Malaysia has been a market that's been ignored by foreign investors. But I think that, given the slowdown in the rest of the world, investors can take a look at Malaysia again, and given the number of policy assignments as well. And also we're trading at quite cheap valuations. So our strategy for Malaysia is that we are positive for the market. We expect improving momentum on policy execution. This year will be a year of execution for Malaysia. We think that there should be a ramp-up of construction and infrastructure projects. Number two, rising FDI is also a catalyst, and we're coming from a low base. In terms of global macro, is that peak interest rates and the US dollar should help flows into EM. So I think last year the ringgit suffered, I think partly due to the fact that interest rates in the US went up by so much. So from a short rate perspective, the gap between Malaysian interest rates and US interest rates was one of the widest in history. So if you talk to an exporter, for them they hold US dollars. To them the reasoning is that, why should I bring back my US dollar earnings when US can give me 5.5%, Malaysia you put an FD, you probably can get 3% or less. But as the interest rates in the US start to come down, then there's more incentive for money to come back to Malaysia, and that will boost the ringgit as well. So we think that when Fed starts to cut, it should also be positive for Malaysia. So the sector strategy, what sectors we like, we like construction and property. We like the tech sector for the tech cycle rebound. We like the utilities and renewable energy space as well. And we also like the banks. More tactical trades is oil and gas and plantation. Those maybe not a buy and a hold, but maybe more situational trades. Okay, so I think I've covered most of the outlook and themes, so just talk a bit about some fund selections. So this is our flagship funds for Kenanga. For those in Malaysia, you have the Kenanga Growth Fund, which is a large cap fund. If you need Sharia, you have the Sharia Growth Fund. And then also we have a blue chip fund, which is focused more on blue chips. For Malaysia Inc. and Kenanga Growth Fund Series 2 is a diversified fund, which invests both in Malaysia and overseas. For regional funds, we also have the Asia Pacific Total Return Fund and the Global Growth Funds that you can look at. So for Kenanga, we have quite a complete suite of products to diversify your exposure between large cap, small cap, Malaysia, and also regional. Okay, so I think I'll end my presentation now.